Hi, everybody. My name is Jack Bruton. I work on the CPMS team with on the client services side. I'm joined by my colleague Ryan Strong, who also works on the client services side. And in addition to Ian Tam, Ian was an account manager with CPMS for a number of years, so you probably came in contact with him at some point. He's joining us as a guest here, and he's going to be sharing sort of his take at the end after I go through US and then Ryan goes through Canada. He'll be sharing his view on the sort of Morningstar's view on some of the long-term effects of GDP of COVID, taking a look at some of the worst drawdowns, and then he's got a really cool sort of single variable test on looking at the biggest drawdowns and also the recoveries in terms of factors that worked or didn't. So we're, and then after that, we'll do a little Q&A at the end if there's anything. And please keep in mind that this session is being recorded, so you can go back and take a look at it after. And you will be given a copy of the presentation. So I guess I'll pass things off to my colleague Ryan Strong, who will begin things with the Canadian side of the quarterly market review.
Hi, good afternoon, everyone. Thanks for joining us. As Jack mentioned, my name is Ryan Strong, and I'll be presenting the Canadian market review for Q1 2020. Also, after the presentation, if anyone has any new ideas to add for the next QMR, please email CPMS support@morningstar.com. We'd be happy to add some new content. So firstly, we're going to take a look at market performance. Then we're going to dive into the best sectors and stocks. After that, we'll take a look at the single factor analysis and model performance. And then lastly, market fundamentals and outlook. So to kick things off, we're going to look at the price change for Q1. Keep in mind, this does not include dividends, just price change. So in January, the TSX comp started a relatively good start, 1.5%. And then things started to slide in February. We were down 6.1 and ended up going into a full correction mode in March, down 17.1 from a price change perspective, down 21.6 over the quarter. From a total return perspective, definitely wasn't the time to get aggressive with small caps, which were the worst performer at negative 38.1 for the quarter. And the TSX comp ended the quarter down 20.9%. So large caps significantly outperformed small caps on the quarter. Next, we're looking at the market breadth of Q1. To calculate this, we look at the amount of stocks that had a positive return in the index. Doesn't matter if they were up 1% or 100%, as long as they were up, it counts. So the TSX comp, 9% of the stocks in the index had a positive return, and only 1% of the stocks in the TSX small cap index. This was actually the worst quarterly Canadian market breadth in 35 years. So next, we'll take a look at the market breadth within the individual sectors, as well as the sector performance, and then some individual stocks. So a number of sectors that had 0% market breadth, 0 stocks in the sector were positive. Energy, consumer discretionary, healthcare, financials, communication services, real estate, always 0% market breadth. And then looking over to the right-hand side, some of the best and worst performers within each individual sector. And then at the bottom, Ballard Power being the best stock in the index, and Shawcor being the worst. And in a couple slides, we're going to take a deeper dive into Ballard Power. Here, we're just another visualization just showing the sector returns. Energy and healthcare having the worst returns at around negative 38%. and then IT leading the way. Keep in mind, obviously, IT being a small subset of the index. So Ballard Power. For those unfamiliar with Ballard Power, it's a hydrogen fuel cell company that makes, its share price has been on the rise for the last couple years. Seems to be finally making some inroads, or the market believes they're making inroads into a lucrative market, powering buses, trains, trucks, etc. Ballard's been trying to break out of its unprofitable niche for years, but despite the run-up in share price, its price-to-sales ratio has also just hit the highest in company history. In conclusion, Ballard has a financially ugly picture, doesn't focus on the pesky things like profitability, instead has been focusing on strong growth prospects for powering electric vehicles with fuel cells. So, given that story and the hot start that it's been on in 2020 with some news out of China that they won't be cutting renewable energy subsidies, let's take a look on how this aligns with some of the CPMS strategies. So how does it look? Here we're showing how it performs, or how it ranks in the CPMS strategies from a percentage standpoint, and then as well as its status. Whether it's a buy, meaning it meets all of the buy criteria in that strategy, a hold, where it's breaking one or more buy rules, but it's not breaking any sell rules, or a sell, meaning it's breaking a sell rule in a strategy. So you can see Ballard is a hold in asset growth, earnings momentum, and price momentum, but is a sell in all of the other strategies. And it's actually not owned in any of our strategies, so this typically wouldn't be considered a strong CPMS stock. However, it does perform within some styles, given its story. You can see what styles it ranks well in. So this is a new slide that we added because of the unprecedented times. We decided to take a look at how the index looked in this first column in November 18th, which was the first known case of the coronavirus. And then the second column, how the index looked on March 23rd, which was the bottom of the market. And then lastly, in the far right column, how the index looked April 17th. So from the 18th to the bottom of the market, there was some significant changes with the S&P TSX. So estimate revisions were being slashed down to 13.3%. Deep cuts from a valuation perspective, yield ticked up to 4.8%. And current year EPS growth down negative 6.5%. And then from the bottom of the market to April 17th, there was some further changes. So yield actually ticked down to 3.7%, mostly due to dividend cuts and the market bouncing back. Estimate revisions were slashed further, now down to negative 22.8%. Current year EPS growth slashed to negative 17.2%. And then the most interesting being that price to earnings actually increased to 16.4%, which is actually more than the pre-corona levels at 15 times earnings. So stocks actually more expensive than they were on November 18th, pre-corona. I'm going to pass this slide over to Jack. He is the brains behind this one.
Yeah. All right. So this is something new that we added. A reason why I added this, it's basically the top 15 stocks trading at a discount from our analyst team out in Chicago. And the real reason why I wanted to do this is I think that it's a stock picker's market right now. I think that there's a lot of value to be unlocked, and this is just some interesting trading ideas, right? And I also think that our methodology right now, the way we value stocks, is just rock solid, and it's I think it's going to really play quite well for us. So I included the list here. So at Morningstar, we're very value driven and long-term investors, and we invest in look at good businesses with a moat. I'm going to talk a little bit about that later. So for this first variable here is the MS fair value. So that's the fair value that we think that the companies should be trading at. This PR now is the price now. It's just there for information purposes. The RMS fair value is essentially the potential upside for these names. So Aurora Cannabis has a potential upside of 412%. And now going to these MS moat. So you've probably heard of moat investing before. It's a very, Buffett-esque term. So it's essentially we're looking for firms and assign them a moat that have competitive advantages and are able to fend off competition. So we assign them either a no moat, which would be 0, a narrow moat, which would be a 3, or a wide moat, which would be 5. And obviously, wide moat is the best. And we evaluate these moats on 5 factors, and I'll just touch on these very quickly. So the first one being intangible assets, right? Do they have any brands, patents, or are they protected by the government or some way, shape, or form? From a cost advantage perspective, are they able to offer products at a lower price than their competitors, right? Giving them advantage there. Switching costs, how painful is it to switch from one competitor to another? Perfect example is Rogers, right? Or switching between Rogers and TELUS. If it's a pain and a hassle for me to switch, that switching cost is high and I probably won't do it. And then the fourth one is a really interesting one, and I feel it's the most powerful, but that's just my take on it. It's not Morningstar's, but it's called the network effect, and it goes as follows. So it's the value of a particular good or service actually increases for new and existing users as more people use the service, and it really creates a cycle that allows strong companies to become even stronger. And examples there would be like Expedia or Facebook. In terms of like a Facebook example, right? Like to say I have a group of friends that are members of Facebook and I'm currently not, right? If I want to communicate with them, I would have to go on to Facebook or register, which in turn sort of makes Facebook stronger, right? Because they're getting more users. Now let's just say once I'm on Facebook, I have another group of friends who don't have Facebook and they want to contact me. They would have to go and sign into Facebook. And it just really goes, it kind of creates that cycle or that cycle effect that I was talking about that really, I think, adds a lot of value. And then finally, we have efficient scale. Efficient scale meaning it's a classic economics, it's like an industry or a sub-industry is effectively run by one or a few competitors, and other companies won't enter that industry because if they do, it would become unprofitable for everybody, so they stay out. And then finally, we have MS star, so it's 5 being the best, and essentially it's the largest risk-adjusted return to fair value. And all of these factors plus more are available in CPMS. And if you do have a little bit more interest in terms of learning about our methodology and how we value things, you can just click this link down at the bottom and it'll bring you to our methodology report. Go ahead, Ryan.
Yep, thank you, Jack. So next we're going to be looking at Q1's best and worst performers. By doing that, we take the top 50 and worst 50 stocks, and we have an average monthly volume screen on them. Looking at the best 50 performing stocks, it's a bit of a mixed bag, but you can see that there's quite a few materials, industrials, and then also utilities. So investors are looking for stable dividends and cash flows with those utilities. And only one consumer discretionary, which is Real Matters, just continuing its tremendous run that it's been on over the last year or so. And then Q1's 50 worst performing stocks, as you might have guessed, mostly energy and materials. And looks like the energy theme is going to continue into Q2. Not sure if anyone could have missed it over the last 2 days, but seems like oil futures are actually going negative. So it's been interesting times. And then we take those lists, so the top 50 and worst 50. So here we're going to be comparing them. So in the first column, we have the metrics for the index, so the TSX comp. In the second column, it's the metrics for the top 50 stocks. And the third column, the distributions between the two. And then over to the right, you can see the metrics for the bottom 50 stocks, and then the distributions again between the index and the bottom 50. So at the start of Q1, the best 50 stocks shared some of the following attributes relative to the index. So they tended to be low beta, they had high earnings variability, estimate revisions upwards, high earnings momentum, and they were fairly valued. Comparatively to the worst 50 stocks, which had very high earnings variability, they had estimate revisions to the downside. They were very undervalued, and that's a common theme we've seen over the last few of these quarterly market reviews, and they had poor growth characteristics. So take this slide for how you will, but what we'd like to do is look at the quarterly performance for Q2 from back to 1956, just to get an idea of how we might do going into Q2 this year. So on average, Q2 is one of the lower performing quarters with a 1.8% annualized return on average, and historically has put up a positive return 63.4% of the time. And then breaking that down by sector, consumer discretionary and healthcare seem to lead the way in Q2. And then materials, financials, and real estate have all lagged in Q2, posting an average return of 1.1%. So what fundamentals did the market reward during Q1? So we're going to take a little bit of a quant dive here. And what we do is we equally weight the best 50 stocks using each of the most commonly used CPMS factors, and then we measure their performance. So we call this the single factor analysis. And this red line here means that this factor did better than the index, and then below that red line, that factor would have done worse than the index or did do worse than the index. So market float, best performing, down 17.9%. And on the other end of it, expected price to cash flow was one of the worst performing variables. That was, you would have been down 62%.
Yeah. All right, can you just go back one slide? Sorry, I just want to add something. Yeah. So it's just something that just caught my eye here is like the expected yield. Like it was down. So if you bought the top 50 names, equally weighted them over the quarter, yield would have come in at 46.1%. Really sort of just caught my eye, just given the fact that I would have thought that, you know, given the declining interest rate environment, people would be looking for yield and buying like higher yielding stocks. And then also when I was making this report, it's you know, we looked at we do in a few slides, you'll see the dividend growth model actually outperformed the market as our top performing strategy, and that has I believe it's a 40% weight on yield. So it's a little, it's just an interesting observation that I saw. And you can see all like the value driven metrics down here, not doing so hot that we sort of previously examined. So just going in, and that's what the 50 worst stocks exhibited within that other attribution strategy. So sorry, go ahead, Ryan.
Thanks, Jack. So here we're taking a look at our CPMS models and their corresponding performance. So dividend growth and Core 20 both outperformed the TSX comp for Q1, with dividend growth posting the best return, negative 17.2%, and Core 20 not far behind. And then for those new to our CPMS models, Dangerous being the worst performing model at the bottom, down 49.6%, doing what it's supposed to do. This is, I guess you could call our short strategy, buying highly levered companies with, you know, declining earnings growth, et cetera. So moving on, here we're just looking at some market characteristics. One that we like to look at is the price to book relative to the ROE of the market. So what you're paying versus what you're getting. So price to book has been coming down, so you're paying less, and ROE has been trending up, so you're actually paying less and getting more. And looking at earnings, actually over Q1, EPS growth was increasing. However, it's expected to decrease going into Q2. And estimates have been significantly revised downwards. So from negative 6.1% to now negative 22.6%. And then from a sector perspective, so a lot of those EPS revisions coming from energy, down 55.9%. And then real estate almost unchanged, down 0.2%. One interesting note here, though, is expected EPS growth is positive in half of the sectors, with bullish sentiment for consumer staples. So 9.7% expected growth for consumer staples. Breaking down the beats and misses on earnings for individual sectors in the market. So 43% of companies missed within the S&P TSX comp, 1% met, 56% beat. And then looking at healthcare, 100% missed. Communication services, not too far behind, 88% of companies missed their earnings. Other considerations, last slide here. Economic outlook, unemployment has increased to 7.8%, and this is something to keep an eye on as it's expected to rise significantly